Good morning, everyone, and welcome to this webinar, the final webinar in our series looking at ideas for your ISA. Shortly, we'll be hearing from Evie Hambro, manager of BlackRock World Mining Trust, a diversified mining trust with a healthy yield, currently trading on a 9% discount. Before we get started, a couple of points. You may find the slides a little bit smaller. If you do, please do zoom in a little bit at the top of your screen. Also, we found through our webinars that viewers get a better experience if they download the WebEx app. So if you're struggling to see any slides, I'd recommend you do that. Hopefully you will know by now the drill, that we have 25 to 30 minutes reserved for the presentation and then some time for questions at the end. Please do put your questions in the box and I'll put those to Evie at the end. So without further delay, Evie, over to you.
Thank you very much, Thomas, and welcome everybody. It's a great pleasure to be back speaking to all of you again on this Kepler event. Just wanted to give you an update on the mining trust and how we've done and our outlook for the future. So just by way of reminder, I'm sure that the World Mining Trust is known to many. UK listed investment trust. Primary focus is on mining listed equities, but we also have exposure to mining corporate debt, to royalties on resource assets, and some exposure to investments in companies that are not yet listed. We use everything that's available to an investment trust in terms of gearing, option writing, etc., and obviously trying to maximize the total return from exposure to the sector through the cycle. The trust is co-managed by myself and Olivia Markham. We've been doing this together for a long time. The trust has actually just passed its 30-year anniversary a couple of years ago. And so yeah, it's been a good journey over that time period. In terms of setting the scene, commodity prices going back over the last kind of 7 years or so, it's been a pretty healthy environment for profitability for mining companies. You can see on the top left-hand side of the page the price of iron ore averaging in excess of $100 a ton for all of the last 5 years. You can see aluminium prices that have been kind of in that kind of mid 2000s. They're now solidly higher and moving in, looks like into a new realm. Copper as well, the copper price now above $5 a pound today, having averaged about $4 a pound for most of the last 4 years. And we're also seeing from the cost side, lower oil prices, those now into the kind of 60s, which obviously is a bit of a tailwind for many companies in terms of their operating margins. How has the sector done relative to broader equity markets? You can see on this the MSCI ACWI index and the global the S&P Goldman Sachs Commodities Index. So you can see how the equities have done. Obviously a very strong period post-COVID with some really outstanding returns. This was a period where the companies were harvesting cash and maintaining a high level of capital discipline, and then more kind of range-bound performance since then, with high yields across the space driving a lot of the total return of the index, but not far away from where the equities as a whole have done, as measured by the ACWI, and obviously outperforming commodity prices. One of the biggest factors when it comes to commodities is China, and you can see, China's, well, I think everyone has known about China's challenges. Obviously, the China boom of the early 2000s, driven by the urbanization and huge investments into property, and we've seen since then, weaker demand growth from China in the 2010s, bit of recovery in the second half of that period, and then kind of more challenged environment. Despite that, demand has been pretty strong, and I think most of the negative sentiment that exists there today really is related to the property sector, whereas other parts of the economy continue to perform pretty well, such as electric vehicles, renewables, infrastructure, etc. And I think it's quite interesting the differential views of what actually is happening there. I was actually in China last week, meeting with companies and clients, and it was really great to be back again after a few years of not having been there personally. When it comes to Chinese demand, I was mentioning how it's evolved. You can see on the right-hand side of this page how the property market in relation to copper, was obviously a very big source of overall demand, and how that is trending lower relative to investment outside of the property sector domestically in China. And obviously the importance of that part, which is growing so strongly, is a key factor in where we think some of these commodity prices are likely to go. Remembering that China represents like a 50% of overall commodities demand, with the exception of the oil and gas sector. That's in terms of its overall market share. And you can see the huge amounts of energy, clean energy spending taking place in China a couple of years ago, and obviously that number continues to grow. Just by way of a reminder, you can see on this chart a bunch of data which just shows you how much more intensive the future economy is going to be when it comes to materials, relative to the kind of post-industrial revolution global economy, where we were very much fossil fuel driven in terms of our energy needs. Installing renewable power, connecting it to the grid, the backup solutions in relation to batteries, the investment in the grid that's going to be required, the intermittency and the challenges attached to that, just make this a much more materials intensive energy solution for tomorrow's economy, relative to the one that we've been so used to for so long. In a way, what we are effectively doing is swapping a lot of fossil fuel consumption for increased use of materials. And this is really going to be a driver of those growth numbers when it comes to the consumption of materials, and how that changes over time. You can see how much more intensive it is, say, looking at copper, when it comes to power capacity there, or steel. It is a very, very different picture, and one I don't think many people truly understand or absorbed into their investment thinking. The other factor that requires a lot of commodities is to move into a more digital economy. This is one that you read headlines about just about every day now. We're seeing massive amounts of money being invested globally. BlackRock's actually at the center of this in some of the deals that it has already announced in partnership with its the new business GIP that was absorbed into BlackRock last year. But just reading about the headlines that we saw in America with President Trump, and the investments from the Taiwanese semiconductor business into $100 billion going into data centers in the US, huge investments taking place there. And clearly you cannot build these things without commodities. And it's no longer just a battle for access to semiconductor chips. It's a battle for access to power. It's a battle to access for cooling, to grid connection, to sites that have availability of power, strategically important, secure sites as well. So this is a major trend of investment, concentrated in a relatively small number of hands, but ones with enormous balance sheets. I often compare the previous China cycle, where that was millions of people moving from the rural environment to the urban environment, and everything that's associated with that. So millions of people buying air conditioning units, or fitting out new apartments, whereas this is a handful of players spending tens of billions of dollars each every quarter in some cases, to be able to deploy the growth that is needed in this move to a much more digital and energy intensive global economy as we go forward. One of the solutions that is often talked about in this regard is, where can the power come from to meet these needs? Now, many of the hyperscalers are focused around trying to get access to not just reliable, low-cost power, but also clean power. In the near term, the kind of main levers that can be pulled here relate to renewables, but as we go forward, say into the 2030s, the role of nuclear is going to play a much increased market share, and we can see that starting to play out. a number of news headlines around the reactivation of mothballed nuclear capacity, or the starting up of projects with underwritten offtakes of power under contract to some of these new players in this space is really eye-catching. And one of the solutions that they're looking at here is nuclear, whether that's traditional sources of supply and nuclear and growth attached to that, or is it this small, medium-sized reactors, the SMRs, that are going to be driving a lot of this new supply. We're seeing some very, very big headlines with huge amounts of money, and that will obviously start to play out in terms of what happens to uranium and also the supply chain from uranium through to the fuel that these reactors require. Gold is an area that we are always asked about, and just recently the interest has obviously picked up with gold passing into new record levels, a price above $3,000 an ounce. This really has been a remarkable journey for the price of gold over the last kind of 3 decades, where prices have gone up close to 10 times in that time period. What are the drivers behind this? Well, what's been interesting recently is a couple of points. What we've seen in the central bank market, which is the bottom right-hand graph on this page, for much of the 1990s, we saw huge amounts of net central bank selling. And this was a big drag on the gold sector, causing prices to go to lower and lower levels. Gold bottoming in around $252 an ounce in 1999, and then when those processes of sales finished, and we had stability in the central bank gold market, prices started to normalize. And then since then, we've seen this kind of trend of central bank buying, averaging kind of 300-400 tons a year. Over the last 3 years, we've seen that number double. Central bank buying has been over 1,000 tons a year, and this trend of de-dollarization amongst central bank reserves has really started to gather a lot of momentum. What's interesting is this has happened at a time when investor demand for gold via physically backed ETFs has been relatively subdued, and that's actually just started to really pick up. We saw some nice growth over the last 12 months, and that's flowed into the first quarter of this year. So that's really starting to kind of get going. If we see both of these things happening at the same time, then you're going to start to see some pretty exciting moves ahead in this space. When it comes to the companies themselves and what have they been up to, on the left-hand side of this page, you'll see the mixture of capital spending for the resources sector, which is split between what they have to spend to keep the assets going. So that's the maintenance, the replacement of trucks, just keeping everything going, relative to the growth or expansionary capex, which is in yellow. And you can see that over the last few years, expansionary capex has been very muted indeed, starting to increase as companies look to do 2 things. One, invest around decarbonization, which is a growing share of that non-maintenance related capex, and then looking to deploy into new growth projects. Now, many of these are projects that won't actually drive overall production growth, more kind of replacement to keep production flat or increase slightly. So in terms of the supply-demand picture, not something that we are looking at as an issue. But one of the challenges that the industry faces is just how much more expensive it is to build new capacity today than it was, say, in the previous cycle. And on the right-hand side of the page, you can see this is the typical cost per ton of annual capacity for a new copper mine. So in the kind of China cycle of the early 2000s, it was costing you around just under $9,000 a ton to build a new copper mine. That number has steadily increased, and the most recent example of a very large new copper mine was the QB2 asset built by Teck, which has now come in at just under $30,000 a ton. So what's interesting is that you've seen this huge increase, kind of 3.5 times increase in the capital cost of building new capacity, or 3-time increase in the capital intensity of building new supply, whereas the price of copper in the previous cycle peaked at about $3 a pound, and today we're at $5. So you've seen a 3-fold increase in the cost of building the things, but you haven't seen a 3-fold increase in price. And so one of the challenges that the industry faces is how do they afford to build new supply when commodity prices haven't kept up at a level that should actually incentivize investment into new supply. And this challenge around meeting future demand needs can only be unlocked if we see prices that truly reflect the cost of building new capacity. So this is quite interesting for businesses that have existing assets and are in production. If we see these prices start to reflect the levels needed to build new supply, that will obviously be very profitable for assets that are currently in production. So it makes companies with listed companies with existing assets look very cheap relative to replacement cost as a metric. Where are we with regards to the companies themselves? You can see on this slide that the sector has done a good job of deleveraging since the kind of peak gearing points of 2015. You can see how much lower those numbers are today and also how they rank relative to other equity sectors. So the mining and oil and gas sectors are some of the lowest levered relative to other equity sectors out there. Now, why is this important? Well, adding gearing and balance sheet debt to a business that is cyclical in terms of its revenue line can add volatility to the outcome for investors in the shares. And so trying to keep those balance sheets under control is a key thing that management needs to really watch when allocating capital within these businesses. Overextending yourself with a high level of leverage going into a volatile price outcome can be pretty disastrous for shareholders if it's not done appropriately. So this is a key thing that we're focused on. But right now, the level of leverage in the sector is actually very low by historical standards and much lower than on many other equity sectors. In terms of overall valuations, you can see that the sector continues to trade at low levels relative to its own history. That chart on the top right-hand side of the page shows you the EV/EBITDA for this sector relative to its past, and you can see that we're trading at pretty low levels relative to that. You can see the dividend yield premium that the sector it trades at today, and how that has been pretty consistent over the last few years as these companies have been kind of harvesting cash from their businesses. And then just looking at more general metrics, PE multiples, price to book, etc., how much cheaper this sector is relative to broader markets, yet still exposed to many of the exciting growth trends around the energy transition, around AI, and so on, whilst also facing the challenges around how to meet that rising demand from some of the supply factors that they have to contend with. Just in terms of an update on our views around trade, it's really interesting to see some of the moves coming out of President Trump's kind of first couple of months in charge. Obviously, huge amounts of volatility that we're seeing here, created by the noise around tariffs, geopolitics, and so on. It'll be fascinating to see when the dust settles on this, how that actually ends up. But right now, it looks as though there's going to be disruption to trade routes as people look to try and find more efficient ways to be able to meet or match up demand and supply, customers and producers, to make sure they can avoid any difficulties with regards to tariffs. But it does seem to be a pretty volatile position right now, with new information coming almost on a daily basis. Also, with regards to inflation, it looks as though that we have a kind of stickier environment. Interest rates are probably likely to remain a bit higher than where people had been expecting them to be. And we'll wait and see how that data with the famous dot plot continues to unfold. But it does look as though a return to the super low rates that we saw a couple of years ago is unlikely to happen in the near term. With regards to our results from the last year, disappointing in terms of overall share price return, and which was pretty annoying actually. The first half was much tougher for the performance of the portfolio. Second half was much better, especially on a relative basis. Some of the areas where we lost ground in the first half were significantly recouped in the second half. We managed to beat expectations with regards to the dividend. I think people had been expecting a lower number than we actually be able to deliver. Certainly when you looked at the underlying companies and how much they cut their dividends, this was a significant bit of outperformance for us relative to what the headwinds that we were facing there. When you look at the overall dividend track record of the trust, very, very healthy levels ever since the strategy was evolved in 2010, where we sought to maximize the income potential of the portfolio, because when you look at the underlying companies, greater than 50% of the total return over time comes from income, and so leaving income on the table was unwise. And by diversifying our sources of income, we're able to shelter our shareholders from some of the volatility when mining companies sought to cut their dividends to zero, say in 2015, 2016. That kind of time period when they were really struggling under the weight of debt in their businesses, we were still able to pay a good level of income back out to our shareholders. Cumulatively, since launch at £1 per share, we're now not far away from 400 pence in terms of total payments, which is a pretty amazing outcome for a single sector cyclical area to be exposed. In terms of the positioning in the trust, this is to the end of January. The biggest positions that we had were towards copper and gold. That is a big change for us in gold. We at the beginning of last year, we continued to be very optimistic on the price, but more questioning when it came to the underlying companies. Their ability to be able to harvest the higher prices and convert them into free cash flow was something that we had to spend a lot of time understanding. And certainly for the first part of the year, that was really a period of disappointment when it came to gold equities. As time went on, prices moved a bit higher. We felt that it was clear room where they would be able to grow margins at these higher prices, and we are optimistic that they're going to be able to continue to do that now that gold has moved through $3,000 an ounce. So we have rebuilt our exposure to gold equities during the year and moved overweight in that space. Copper, that number there is actually slightly understated because a large part of the diversified part of this portfolio is also exposed to copper. So when you add the kind of see-through mix from the diversified into the copper bit, you'll see that copper is actually our largest weighting, and that has hurt us, especially year to date, where copper equities have underperformed the price move itself. Copper prices, as I said, up strongly through $5 a pound or over $10,000 a ton. Yet copper equities have lagged that rally, whereas gold equities are up kind of 30% for a kind of 12% move in the price of gold. So we're looking for that beta in the copper space to really start to catch up, and I think these earnings in the first half of the year are going to be a key factor, and see whether these companies have been able to capture that. In terms of our top 10 holdings, you can see the mix here and the gearing level at around 12% as at the end of January. So just in terms of summary, I'd say that fresh back from a trip to China last week, we're actually more optimistic in terms of the government there looking to put measures in place to support growth, especially in the commodity intensive areas. A better understanding about how much lower the property sector is in terms of overall consumption, especially in terms of growth, and how much more is going into the industrial infrastructure, energy transition, and digital space, which continues to be very materials intensive. The US, clearly the onshoring trend, reshoring, onshoring is massive. We're going to see huge amounts of investment taking place there. Almost every day there's an announcement from a company going to the White House and partnering up with the government in terms of onshore investment to increase their resilience in the face of geopolitical challenges. And I'd say the newest bit of news when it comes to the demand side is what's happening in Europe. the announcement from Germany of 500 billion euros, which is now kind of passing through its regulatory processes domestically. The announcements from France as well. This is net new demand for commodities that's going to be rolling out over the next kind of decade. This is very, very big event. You know, Europe has been this kind of sleeping giant in terms of commodities demand with very, very little growth. If that really starts to wake up, the power of three, you know, China having kind of becoming better, the US revitalized by Trump, and Europe this kind of injection of enthusiasm with regards to growth around unleashing the spending there. You know, you really could have a coordinated or synchronous picture for global commodities demand growth, which is very exciting when it comes to the tightness in world markets right now. In terms of valuations, as I mentioned, they look low. The dividend yields remain strong. The company, the trust itself, is very well positioned with our key bets around some of the kind of highest cash flow producing areas. You know, we're seeing great growth in dividends with regards to the gold sector. We're seeing the resumption of share buybacks across the resources space, and so, you know, all in all, I would say that a lot of these positives are not reflected in many of the valuations, and therefore we remain, you know, well positioned with our gearing attached to our conviction in terms of that outlook. So I hope I haven't overused my time. I think that's about 25 minutes, and I'm happy to hand back to you, Thomas, for some questions. You're on mute, Thomas.
Forgive me. Seem to have unmuted and muted myself. Thanks very much for the presentation, Evie. If you're in the audience, please do add any questions. We have a couple coming through already, but we've got plenty of time, so should be able to get through them. To start with, I was interested, I mean, we ended by talking a bit about valuations. Are these low valuations sort of evident across the sector? So specifically the copper miners, we spoke a lot about the strong structural outlook for copper. Are the copper miners also cheaper, the specialist miners? Are there particular areas where that valuation opportunity is concentrated?
No, I would say, as the graph showed you, the overall sector itself is trading cheaply relative to its own history and cheaply relative to world markets. So that's your starting point. Obviously, within that mix, which is an average, there are some that are more expensive than others. And what we've tried to do is position the portfolio, as we always do, into the areas that we have the highest conviction to capture that total return through the cycle. And so we've got a mixture of companies that we think are trading cheap relative to the growth that they have, others that are cheap relative to their own levels of free cash flow generation, others that are more speculative in nature, exploration companies and so on. So trying to build that kind of virtual mining company by investing throughout the sector, that's one of the kind of things that we try to do. So, you know, we've got a little bit of everything in there, but we hope the mix is going to deliver that investment goal.
Could you, question from the floor, could you say more about the virtual mining company, what it is and what's the benefit?
Yeah, it's a good question. It's something that we've done for most of the trust's history. So what we do is we look at our portfolio as if we had the pro rata production of each of the underlying companies that we own. So if we have, I'll make something up, 5% of a company, then we would say, right, well, 5% of that company's production of a certain commodity, 5% of its cash flow, 5% of its balance sheet, 5%, of its capital spending, etc., etc. And so as you build up the portfolio on a pro rata basis, you get a mix. And so if you take the trust, which is around £1 billion today, as a £1 billion company, in inverted commas, the virtual mining company, you can see how much see-through production of copper and iron ore and gold and so on, that company would, in theory, be able to produce. And you can see how that is trading relative to the broader sector, and we trade cheaply relative to the broader sector today, which is a frustration. I'd love that we traded expensively, but we don't. We trade cheaply relative to the broader sector. We offer a better dividend yield, a stronger balance sheet, better growth outlook, and so on. So that's one element of it. The second element is obviously we have access to greater levels of liquidity than the underlying companies. So if we wanted to move the needle in terms of a commodity switch, it's much easier for us to sell the shares in companies producing a certain commodity and buying shares in a company or range of companies that produce a different commodity. So we can switch that commodity mix more easily than the underlying companies, who would need to spend several years of selling assets and then buying or building new ones in order to achieve that same outcome. What we're seeing right now in the sector is exactly that taking place. Many of the big diversified mining companies have sold off non-core assets. They've sold down exposure to fossil fuel production, and they are spending huge amounts of money either building or buying in exposure to copper. We can do that for far lower cost and far more quickly. And so if we can get ahead of that curve, there's a good chance that we're going to be able to generate good returns by being ahead of what the underlying companies are doing. So that's the concept of the virtual mining company.
Great. We had a question on gold. It's had a very strong run. Do you worry that it might be moving into bubble territory, or do you worry that it might be a dangerous place to have a large part of the portfolio invested in?
Yeah, so there's a number of ways to answer that question. The first is, when we look at gold itself, there are kind of two things that we focus on. How has gold kept up with the cost of living, the purchasing power of gold? Has it preserved your purchasing power as an owner of gold relative to paper currencies? That's one measure. And then the second measure is looking at gold relative to its own cost of production, and to see whether the underlying companies are making supernormal profits relative to what they have done in the past. And if on the second one, if the price is way too high and the companies are over earning, then obviously the price is likely to be unsustainable, and it might have gone up too far, too fast. That is not the case today. The companies are not over earning. They're earning a good return today, and we hope a better return in the future as they get a longer period of time exposed to these prices. Then they should be earning, strongly double-digit levels of free cash flow, which is great, but certainly not over earning in terms of profitability or reinvestment needs to put money back into the sector. The earlier one, in terms of preservation of purchasing power, is really interesting. So there's lots of different ways that you can look at this. My old boss was a man called Julian Baring. He was one of life's great individuals, and he used to look at the cost of eating in the Savoy for lunch using a gold sovereign, and he would take back over the best part of 100 years and see how many people you would be able to entertain there for a cost of a sovereign, and that was a measure of real life for him back in those days. We've updated that, and we now look at it relative to some things as simple as, say, I don't know, a Big Mac, which has been pretty consistent. So we've got some great data that shows you back in 1970, $10 would buy you about 15 Big Macs, and that would cost you about 0.28 of an ounce of gold. Today, for $10 you get just under 2 Big Macs, whereas for the same amount of gold you get over 100 Big Macs. So easily preservation of purchasing power. More recent example would be, say, the iPhone. The iPhone is now the iPhone 16. It's been going for 16 years. The first iPhone came out at about $500 to $600 for an iPhone. Today's iPhone is about $1,500. The amount of gold that you needed to buy the first iPhone compared to buying today's iPhone, the amount of gold you need 34% less gold today than you would have used to buy the first iPhone. So again, that preservation of purchasing power is a key characteristic of gold relative to paper currencies. And it's exactly what I said earlier on around the central banks. They're seeking to de-dollarize. They recognize the loss of purchasing power in owning US treasuries, not being compensated for the risk that they're taking, and seeking to diversify. Don't want to go into euros. Where else can they go? And gold is the natural place, and many of them have far too low a level of gold in their reserves relative to their international peers. So there's a kind of long runway of buying in that regard. So on those two measures, we think that today's gold price is not at too high a level relative to either of those metrics.
Very interesting. Changing tack a little bit, we did discuss a bit US tariffs. Could you give us a little bit of an idea on the net effect? So, for example, will they drive commodity prices higher? Or could they lead to tariffed countries dumping their commodities at lower prices? How do you see this playing out roughly?
Yeah, I think we touched on this in the presentation. So I think you have a number of ways of looking at this. So from a pure kind of economics point of view, tariffs are just a frictional cost of global trade. They distort trading routes and repurpose them or redirect them, and the world tends to find a way to minimize the burden through time. So as an example, you've got the threat of or the implementation of tariffs on Canada from the US, where they will be large tariffs on the supply of aluminium and steel into the US market. This was a well-established trade route, deeply efficient, low-cost power in Canada, producing high-quality aluminium supplied into the US market, into property and auto manufacturing. The implementation of tariffs, raises the cost to US businesses for buying that material. So, are they going to buy it from Canada, or are they going to start to source it from elsewhere? If Canada can't sell it into the US, then they're going to have to find a new customer for that doesn't have those levels of tariffs. So there will be an increased cost of movement of material for longer distances, probably a higher carbon footprint attached to that as well. And the metal will find its way into a new market that doesn't penalize it with regards to a tariff. Whereas countries that don't have those tariffs will be supplying their metal into the US market, and there'll be an arbitrage that exists that commodity traders can make healthy returns out of. The person who pays the bill is the end consumer, whether it's the individual or the company. So it just adds that frictional cost to doing business, and the market tends to react, adopt, and then trade based on them remaining in place. And then when someone else comes in and tariffs are then reduced or removed, then the market adjusts, puts in place new measures and adapts and trades going forward. So they tend to be kind of impactful, and then the market just moves on from the noise. So right now I think it is distorting. We're in a period of volatility attached to the uncertainty around them, and I think over time the market will then settle down.
Do you think that's one reason for the valuations in the sector being low at the moment?
I don't think so, actually. Not at all. I think some of the views on valuations is that the sector, is very small today. The world's biggest company, BHP, 150 billion US dollars. Nvidia's market cap moves by more than that in a day. So the sector is very small. It's kind of out of sight of most people's minds. But if it didn't exist, we wouldn't be in these offices. We wouldn't be having the power coming through. We wouldn't be building new infrastructure. There wouldn't be an energy transition. We wouldn't have electric vehicles. So we wouldn't be building data centers. So the integral nature of what these companies produce relative to the direction that the global economy is going in is unquestionable. What seems illogical is how little people are prepared to pay for the supply of things that are so essential. And I think there's a kind of general complacency around there will always be supply, which is probably accurate. But that complacency means that you tend to underinvest into supply, and then when everyone needs material at the same time, you then have a panic. And that's certainly what's happening in government circles. If you look at the measures that President Trump has announced with regards to domestic US minerals policy, looking to try and clear legislation, get things going, and so on, it's very ambitious. And we'll see whether or not some of the projects that have stalled for so many years with regards to environmental legislation and so on will get through. Normally, when you want to reactivate some of these projects, you'll then have to do new environmental studies or update them. That takes several years. And Trump's got 3.5 years left in the White House. So do these projects get through the processes with his support in the time that he has left, given how long it takes to kind of get them back up to a process? And then you've got all of the things around appeals and so on that people who don't want them to happen will undoubtedly relaunch. So I think it's ambitious. I think some projects will get lift off momentum, others will again be held back, and so I don't think it's going to unlock the supply in the short term that people might anticipate, but I think what it's doing is it's obviously making it's waking people up as to the needs. Europe is certainly of the recognition that they have a critical minerals policy. China has been doing a long dated strategy about access to commodities by building new facilities all over the world, trade routes and so on, one belt, one road. So I think there is a general kind of minerals or materials arms race going on, especially for some commodities that are so key for the outlook for the future, copper in particular, and many rare earths and so on. So I actually think the market is a bit complacent in terms of its view on supply, and that probably feeds into combines with the lack of relevance and that complacency in terms of what they're prepared to pay for the companies. So I think actually there's a huge amount of value relative to what these companies represent in terms of the global economy, and I think given time that will start to show through.
And when you show your graph of expansionary and replacement capex, and expansionary capex picking up in the last few years, do you interpret that positively then? Is there still a kind of a backlog, if you like, that needs to be made back? Is there a point that we would start to worry that maybe the past mistakes are being repeated?
Great question. So I think the first thing, that represent dollars. Even though it's a percentage number, it's the split in the dollar amount of that goes into capex. And so, as I showed you on the other side of that same page, a dollar doesn't get you as much as it used to. It's gone up by 3 times in terms of the copper intensity of dollars per annual production unit. So $1 billion today doesn't build you what $1 billion used to. So even though the split is a greater percentage, you're probably not seeing the same output per ton because it's costing you more. That's the first thing to say. I think there isn't really a backlog. One of the challenges that the industry has faced is that there is a shortage of supply growth options, and that's been a real challenge, and that's why you've had the M&A going on with companies looking to buy growth options to build a pipeline that they can invest in for the future. Many of the companies have been on a pretty ambitious, aggressive strategy there, and they've been able to rebuild that growth pipeline and the options attached to that. The next question is, how do they fund that through time, and what's the timing that they do in terms they can't do them all at the same time. That was a huge mistake from the past when they had too much on, and they lost that kind of ability to be able to manage the projects. They just didn't have enough bandwidth to be able to take them all on at the same time, and the capital costs exploded to too high a level. So I think there are some strong lessons that have been learned from the past, and they're still in place today, but it is very much something that we're watching. We don't want the companies to go in the wrong direction when it comes to overspending.
A question on uranium. Are you looking to increase your exposure? And also, could you clarify the current exposure? Is it 3.1% or 1.3%? Yeah, good to get your thoughts on that.
So where are you looking at that? On this slide here?
So the questioner is comparing the slide,
the pie
chart to
the
website.
Yeah. So that's about 3%. Yeah. So that number is at the end of January. It's a bit lower than that today. We've taken some profits across that space.
And are you looking? So I take it the answer then is you're not looking to increase exposure if you've been taking profits.
No, definitely. We as I said, the trend is there. It's just a question of getting the timing. We're going to see a pretty tight uranium market as we go into the next decade. That's quite a long way away. So we will be monitoring that closely to look for the right opportunities at the right entry point to be able to get that trend.
Got one more question from the audience. I think maybe a last call if anyone's got a question to chuck in. So in our sector, we've seen the infrastructure trusts trading lower as interest rates make them less financially viable. Could the same dynamic affect demand for copper?
So I think there's two very different things mixed there. Leverage against a bunch of fixed assets compared to their cash flows, I wouldn't necessarily say is linked to the price of copper. From what I have seen, this is obviously a personal view, when I look at some of these infrastructure assets, the renewables ones and so on, there were a couple of challenges made. And the first is, raise capital in terms of equity, go and borrow a bunch of money, build renewable assets, and at the same time give a dividend commitment. What then changed as interest rates went up. So the cost of the leverage, has consumed more of the free cash flow, meaning that the dividend commitment is obviously at risk, forcing many of these companies to then sell assets at lower valuations because they're valued against the infrastructure, the interest cost. And so you've had this bit of a kind of challenging environment where you've kind of got in at one level and having to get out at a different level. Obviously discounts have blown out. So that's what I've seen has happened in the infrastructure investment trust space. When it comes to the cost, the building of new infrastructure, we're seeing huge amounts of money being allocated there. I mean, the energy transition alone, depending upon who you read, is minimum of $1 trillion a year for the next kind of 20 years. And it's some people talking about numbers way bigger than that. You've got enormous numbers being allocated towards the digital space as well, that's not going to be affected. This is hyperscalers spending tens of billions of dollars a quarter in terms of rolling out of data centers, grid connections, etc. That's associated with that, partnering up with utilities. The benefits going through into many of the electrical equipment suppliers, the transformers, the batteries, and so on. The rollout of increased renewables, continues at a very, very aggressive pace. All of that spend is pretty materials intensive, and within the materials mix, there are some commodities that benefit more than others. Copper is one of those. Steel would be another one. So we have a pretty supportive demand environment, and I think that that is very much going to be in place for many, many years into the future. So going back to the question, is that outlook challenged because some investment trusts took on too much leverage to buy infrastructure assets? I don't think so.
Great. Thank you very much, Evie, for your answers, and thank you for a great presentation. Thanks to your interest if you're in the audience. Hopefully the recording and the slides of this presentation should be available on our website shortly, alongside all the other presentations in this series. Hopefully this and the others were useful as you come to plan your 2025 ISAs, and we hope we'll see you again in the future. Evie, one more time, thanks very much for your presentation, and have a good day.
No problem. Thanks very much, Thomas. Bye-bye.
Bye.